Welcome to the 3 Edge Week in Review for the week of February 7th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer at 3 Edge Asset Management. Today, along with a quick recap of the activity in the global capital markets, Steve and I will be discussing the yield curve, a topic that has been in the news recently because of increased inflationary pressure and shifts by the Fed and other of the world's central banks towards an overall tightening of monetary policy to combat rather dramatic rise in inflation. But before we get to that, let's get caught up with the activity in the global capital markets this week. And it was another volatile week in the markets. Equity markets rallied earlier in the week as investors seemed to reconsider whether they had perhaps overreacted to the Fed's plans for raising interest rates in 2022. However, then on Thursday, equity markets reversed course and sold off on the basis of a report that showed that the consumer price index had increased by 7.5% year over year in January, the highest level in 4 decades. January also marked the 7th time in the past 10 months that the core CPI, which excludes food and energy, rose by at least 0.5% over the prior months. Investors seemed to be hoping that the report would indicate that perhaps the rate of inflation had peaked, but that wasn't the case. And in the bond market, yields on back of the CPI report rose. The 2-year Treasury yield, which is often associated with basically market consensus for future Fed rate hikes, it rose from, this is interesting, 1.36% to 1.63%. So it was at 1.36 before the report, and it went almost immediately to 1.63%. Yield on the 10-year U.S. Treasury also pushed through the 2% mark. So investors are trying to figure out, how do they position themselves here in 2022? Equity markets are, still at high valuations. Inflation certainly seems less transitory than the Fed had hoped. And so investors seem to be anxiously seeking to figure out, how do they position themselves? How fast will the Fed raise rates, and by how much? So let me bring Steve into this conversation now. So Steve, in response to this, rising inflation, and the Fed, as well as other of the world's central banks, have either announced or actually begun to raise interest rates and tighten monetary policy to combat inflation. And this has brought to the fore conversations about how central bank policy will impact the yield curve. So let's level set here, explain exactly what the yield curve is, and what it can tell us as investors, and why, particularly now, it's important to pay attention to the yield curve and the shape of the yield curve. And, and get ready for the video today. I was reminded how, oftentimes in our industry, we tend to speak in jargon and throw around terminology and assume everybody knows precisely what these things are. The yield curve is very important, though. So why don't we start with just a simple explanation of what it is? What does it represent?
Fritz, I think it's really great that you're focusing on the yield curve right now, because the yield curve has been proven to be one of the most reliable economic and market indicators over the decades. So the yield curve is simply the difference between the long-term interest rate and the short-term interest rate. And often people look at the 10-year U.S. Treasury bond yield as the long-term rate. And for the short-term rate, they might look at either the 2-year Treasury yield or the 3-month Treasury bill yield. And you simply take the difference, the long-term yield minus the short-term yield, and that's your measure of the yield curve slope. And why is that important? Well, it was first discovered and written about in a famous paper by an economist named Knut Wicksell back in 1898. And that paper that he wrote is still, I think, one of the best explanations for why the yield curve continues to work over the decades. And simply, or at the risk of oversimplifying, what I could say is that when you have a big difference, or a steep yield curve slope, so you have a big difference between the 10-year yield and, say, the 3-month Treasury yield, that encourages the financial system and the banking system to issue more loans, to lend more money to businesses, to lend more money to homeowners in terms of mortgages and so on, because banks typically borrow their money from depositors who place the money in savings. And the banks pay them a rate that's much more tied to the 3-month yield, short-term yield.
Mhm.
And then they take that money and they lend it to corporations or to people at a long-term rate that's tied more to the 10-year Treasury yield. And so the bigger the difference is in the yield curve, the more money they can make, the more they're encouraged to lend, and the faster the economy can grow and the more people can spend. And so we call that a normally sloped yield curve. And you see the short rate and the long rate, as you can see in the chart. What's different is the inverted yield curve.
Right.
That's what happens when the short-term interest rate now gets as high or higher than the long-term rate. And that completely demotivates the financial system, the banking system, from economic lending, because why would they want to lend money at the long rate where they have to pay the short-term rate to borrow the money? And there's no spread for them to make an interest margin or a profit. So
Mhm.
that tends to contract economic growth, contract consumer spending, and often leads to recessions. So it's a very important aspect. And one thing to remember is
Mhm.
that in the Fed, which controls primarily the short-term rate, either causes a steep yield curve or inverse yield curve. It takes several months before that yield curve changes, before it ripples through the real economy. And that's why we often have cycles.
And that's why every time it happens, sort of market prognosticators say, "Oh, this time it's different. It's not going to have any impact." And yet, sure enough, with enough of a lag, it does tend to kick in and be a very accurate indicator. So that's
I've seen it
perfect.
happen in every cycle, yes.
So now we have a working definition. So now I think it would be really interesting if you went into just a little bit of detail, because I know that the way that we analyze the yield curve is different and that we feel like we can extract more relevant information based on the way that we do it. So maybe you could just explain how we analyze the yield curve and what it can tell us.
So, doing research over the years, we find that the conventional way that people measure yield curves can be misleading at very important points, turning points in the markets and the economy. So, for example, convention would just suggest look at the 10-year Treasury yield, look at the 3-month Treasury bill yield, subtract the two, and that's your yield curve slope. But that could be misleading for a few reasons. So, one adjustment we make is we notice that in the past, there are times when the banking system becomes dysfunctional, like what happened right before the financial crisis of 2008. Banks were having a lot more risk because they got way over levered in the mortgage market. Banks were recognizing that risk and demanding higher and higher interest rates to lend to another bank because they realized the banking system was getting less and less safe. And that's when the interbank lending rate started to rise far above the Treasury bill rate. And we call that the TED spread, the difference between what banks charge to lend or borrow money with each other versus the government. When that TED spread rises, it's a sign that there's dysfunction in the banking system, and therefore is a financial tightening going on. But if you just look at the Treasury bill rate, that stays low because people are nervous about the market. They
Right.
run as a safe haven into treasuries, and you have this artificially low short-term rate. And if you use that to measure the yield curve, you get a misleading indication that all is well when actually things are not. So we make an adjustment where we add the TED spread to the short-term rate to get a more sure and accurate sense of financial easing or tightening. And it was very helpful to do that before the financial crisis of 2008. And you would have seen that the yield curve by that adjusted measure was inverted when other people were still seeing it as steep and not ready for the financial crisis to begin. Second adjustment we make has to do with all the money printing or quantitative easing that the central bank engages in. After they dropped interest rates to zero a couple of years ago, they
Mhm.
said that still wasn't enough stimulus. What can we do more? So they began to print reserves out of thin air and use that to buy bonds and expand their balance sheet. And that was a form of stimulus that couldn't be measured by looking at the treasury bill rate because it hit zero and it didn't go negative. And in our algorithms, we've computed that quantitative easing, which was extraordinary over the last 2 years, more quantitative easing last 2 years than the previous 107. That was equivalent to dropping the short-term treasury bill rate from 0 to minus 1.5%. So that's another adjustment that we make. So we think that the yield curve has even been steeper than what most people have been seeing because they haven't accurately measured the impact of all this quantitative easing. Then there's a third adjustment we make, and that's that it's not sufficient to just look at the yield curve in the US to describe what's going to happen to the US economy, because most of our companies export outside the US and are dependent on economies outside the US. So we do a blended yield curve where, yes, we look at the US yield curve as we adjust it. And then we look at the yield curves of the countries that we export into in the proportion that we do the exporting by our 500 largest companies in the SP 500 index. And we blend that into a global yield curve. So we put that all together, we believe we get a more accurate measure of what the yield curve is really trying to tell us. And that's borne out in our research over the years as being a more accurate predictor than the more conventional yield curve.
Very good. Very interesting and a much more nuanced approach. So my final question, as always, concerns our outlook and what might we expect will happen with interest rates and the shape of the yield curve in 2022. I mean, of course, no one actually knows, but could we have the yield curve flatten or possibly invert this year? And faced with that uncertainty about the future shape of the yield curve, how should investors consider positioning themselves in such an environment?
Well, one of the uncertainties is that everybody's playing a guessing game as to what the Fed's going to do. The reason why that's a difficult game is that the Fed hasn't decided yet what it's going to do because it has members who are on the voting committee who have very different opinions. Some members recognize that the Fed has been extraordinarily late in responding to inflation. They believed their own forecasts and economic forecasts that inflation was going to be transitory or temporary. And that proved to be not at all the case. And they're anxious to want to raise rates as fast as possible and to stop the quantitative easing as fast as possible. On the other hand, there are other members of the Fed who still believe that while inflation is more elevated than they expected, will come down very soon. And they really don't want to do anything to upset the economy. So there's going to be that debate going on. And the Fed itself doesn't know exactly how things will happen.
Right.
And so far, while they've tried to begin to talk tough about inflation, their actions are anything but. Still, as we sit here today and record this video, they are still printing money as we speak. And interest rates are still at zero, despite the fact that inflation is 7.5%. So the question is, will the yield curve or can it invert? And the way it could invert is if the hawks on the Fed prevail, they have an emergency meeting, or at the next meeting, they hike rates at an accelerated rate, higher than expected, and then they continue to do that. And if the short-term rate goes up quickly, and the long-term rate doesn't budge, that's when we get the inverted yield curve. And the reason why that might happen is that investors might think if the Fed's going to be that strong in responding to inflation going forward, that maybe we will have a weakening economy. It won't grow as fast. Maybe we'll finally nip inflation in the bud and the long rate stays low and we get an inverted yield curve. Now, the reason why that might not happen is that the Fed does not want to invert the yield curve, and that might keep them from hiking rates at a rapid rate, but that might keep inflation growing higher and higher. And if the market believes that the Fed loses all credibility and is not going to be able to tackle inflation, then that long rate might rise, and we might continue to have a steeper yield curve.
And how in the heck, with all that uncertainty, should we as investors think about positioning our portfolios? That's a lot of moving parts.
There's a lot of moving parts, but what I think people should consider is that with all that uncertainty, there's still a chance, since the yield curve is still sufficiently steep right now, that the market that the stock market bubble could continue for a bit longer before it corrects. So that's certainly in the cards. But the risk is when it finally corrects, it could hurt the stocks that are most overvalued. So our strategy is to focus on what we call short duration assets as opposed to long duration assets. And in the stock market, it means focus on those companies that are not so overvalued, that might be relatively undervalued. And those are more the value stocks that are tied, whose fortunes are tied to the real economy, which is still quite strong. And steering away from those stocks that are highly speculative and depending on speculative gains way off in the future, because as interest rates rise, those future prospects get discounted with a higher and higher rate and are not worth as much. And then in the bond market, continue to focus on lower and lower durations and focus on real assets as opposed to financial assets. And where real assets like commodities and gold have a negative correlation to financial assets, that almost always is like a negative duration asset to complement your other fixed income.
Great. Excellent. Thank you. That was terrific. I think a really good explanation of the yield curve, why it's important and what it could tell us. And I do think now more than ever, people really just need to understand it and, and have a feel for what the yield curve might be telling us this year. So that will do it for Steve and me. Remember, all our videos are available on our 3Edge YouTube channel. And in addition, all our videos and all our written commentaries as well are always available on our website, which is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.